Hey everyone, welcome back to Corporate Decoder. Today we're diving into the financial world of the Federated Hermes Total Return Government Bond Fund, and I promise, even though it sounds a bit dry, there's a story here of how even government bonds can have their ups and downs. It's like watching paint dry but then finding out the painter used glow-in-the-dark pigments. This is their annual report, basically a yearly checkup for the fund, covering March of last year to February. It tells investors how the fund performed, what it cost to run, and what kind of investments it holds. The goal of this fund is to give investors returns, which is money that keeps up with current income by investing mostly in US Treasury stuff and other related deals. First, let's talk about costs. For every $10,000 invested in the institutional shares, it cost about $33 a mine, or 0.32%. In Class R6 shares, it's a bit cheaper at 32.2%. In Class R6 shares, it will be cheaper at 32.2 at 32.1%. For service shares, it will be 0.66% or 68. So a lower percentage is better. So what happened to this fund's money? From management's view, the sector allocation, meaning where they put the money, was good thanks to government-backed mortgage securities. On the not so good side, they use things called derivatives to manage how long their investments last and the yield curve. Those derivatives dragged down the return. Also, picking specific bonds didn't help as much as it could have. Let's get into the real numbers. For the institutional shares, the fund returned 520% this past year, but if you look at the past 5 years, it's actually down by 1.05%. Over 10 years though, it's up 1.000, up 1.000, it's up 1.000, it's up 1.000 with an average break even over 10 years. The benchmark, the Bloomberg US Aggregate Bond Index, had similar results in terms of underperformance. Some key numbers: the fund has about $200 million in assets and holds 105 investments. Portfolio turnover, which means how often they buy and sell investments, is 21%. So a little more than 1/5 of the portfolio was exchanged during the year. Where's the money? A big chunk, 44.4%, is in US Treasury securities, and 48.9% goes to US government agency mortgage-backed securities. 1.8% is in cash, meaning it's liquid and ready to be invested or used. The remainder is in other government mortgage-backed securities and other investments. The fund has a code of ethics for its top executives. There were no changes to this code during the year, and no waivers, which are exceptions, were granted. You can request a copy of this ethics code if you are interested. The board has financial experts on its audit committee. That means these people know their numbers and are there to keep an eye on things. The audit fees were around $36,000. That's what they paid the outside accountants to check their books. It's actually slightly more than the previous year. All the audit work was pre-approved by the audit committee to ensure the accounting firm remains independent. The investments show more detail. 44% are in US Treasuries and 42.5% in mortgage-backed securities. Collateralized mortgage obligations, or CMOs, make up 6.4%, and commercial mortgage-backed securities are 4.9%. The total investment in securities is about $220 million. After subtracting liabilities, the fund's net assets are around $200 million. After subtracting liabilities, the fund's net assets are around $200 million. For the year, they ended up with about $9.8 million from investment operations. They distributed or paid out about $8.4 million and $838,891,838. On the institutional shares, the net asset value, or NAV, began at 921 SIN and ended at 9.848. So it increased slightly. The total return was 5.20%. At the end of the year, there were roughly $105 million in assets. Most of the expenses came from investment advisory fees and administrative fees. In turn, those fees were waived, so the investor doesn't have to pay as much. The investment advisor fee is 0.25% of the fund's daily net assets. However, the advisor sometimes chooses to reduce the fee to keep the fund competitive. Every year, the board reviews the contract with their investment advisor, Federated Investment Management Company. After looking at everything, which include the fund's performance, the fees, the financial state of Federated Hermes, and if shareholders will be affected, the board looked at how the fund performed compared to similar funds, such as one ranked by Morningstar, and discussed their performance with Federated Hermes. Ultimately, the board voted to keep the contract with Federated Hermes. The board carefully considers information before it in all manners. At a meeting back in October, shareholders elected trustees. The listed trustees' total voting was generally in the same range. Finally, the company's top executives believe that their financial reporting procedures are effective and there were no major changes to their financial controls during the year. So what's the story here? Federated Hermes Total Return Government Bond Fund is trying to give investors returns with government bonds something low risk. They're trying to achieve market level results. The management fees are low, and you can see that their fees reflect what is actually paid to executives. Federated Hermes appears to be in a generally fine direction. Their underperformance against some benchmarks and peers could be an opportunity to see if there could be increased performance and better strategies to be better than just being fine. Thanks for watching. If you found this breakdown useful, hit that like button, leave a comment with your questions, and don't forget to subscribe for more deep dives into the world of corporate finance.